And is the rise of Main Street actually benefiting Goldman Sachs? Goldman's been sitting at all-time highs after another 4% gain over the past week. Goldman, in fact, has climbed 47% so far this year, making it the best performer in the Dow. It's even outperforming the financials ETF, which is up 30% year to date. Since CEO David Solomon took the helm, Goldman shares are up 71%, and he has made some major changes. While Goldman launched Marcus, its consumer arm, back in 2016, the push into Main Street lending really ramped up in 2019, highlighted by that credit card partnership with Apple. Goldman is also doubling down on technology, recently hired a former Uber exec who specializes in fintech and payments, and it's hopped on the crypto bandwagon by offering high net worth clients access to Bitcoin investments. Joining me now to dig into Goldman's evolution and its valuation, Jeff Hart is senior research analyst at Piper Sandler, and New York Times reporter Kate Kelly is here as well. And it's great to have you both here. Kate, let me just start with you. Does Goldman still represent Wall Street as far as you're concerned?
That's a great question. I certainly think about it as a Wall Street firm when I read about it for the New York Times, maybe even sort of the Wall Street firm, because its brand and its franchise, I think, still loom very large in people's minds. And that may be actually partly because so many of their alumni go into government. So they may have like a slightly higher profile than some other banks. But it's a good question, Kelly, because I do think all of the one-time investment banks have sort of morphed into different ways. I mean, Morgan Stanley obviously has gone very deeply into the wealth management and also sort of the retail wealth management business, the mass affluent. JP Morgan, Citi, Bank of America, obviously are universal banks and were pre-crisis as well. And then you have Goldman, which is only just now sort of ramping up this consumer business. If you talk to some analysts, I'm eager to hear Jeff's take, they would tell you their clients hate the retail business for the most part, and they don't know of almost anyone that's investing in the bank for that reason. But that said, it has been a priority of David Solomon's and Lloyd Blankfein before him. They have seen some growth. There's been some realignment in that money management business, and it seems to be doing very well. Asset management, which is separate from the retail, had a very good first quarter. And it must be said, the first quarter had record revenues.
Wow.
They're on track right now to make well over $1 billion in revenue per year, which sort of blows away their pre-crisis record.
So, Jeff, let's turn to you on that note and ask, is the retail business something that attracts people to Goldman, helps account for its outperformance this year or not? I mean, is David Solomon kind of a key person here in revaluing this company, or is it just the market environment, right? The fact that rates are up a little bit and that sort of thing?
I think on that end, it's a little bit of both. I mean, capital markets have been really strong activity levels wide, and that plays into Goldman's hands. So certainly that's kind of given them some tailwinds, too. But David Solomon's making a lot of changes, and I think a lot of good changes that are starting to show up and bear fruit as far as generating revenues and improving kind of profits. I think there's a fundamental shift kind of going on within Goldman, as well as kind of being exposed to the markets, which have been really strong. And yeah, I mean, the Goldman Sachs shares have just been on fire, right? I mean, they've been up a lot this year. We liked them a lot at the end of last year, but even after the current run, I still see a lot of upside in these shares as we look forward.
So let's talk about that, because you just raised your price target, Jeff, to $420 a share. That's only about 13% upside or so from here. How do we know this is, are we talking about price to book? Tell me about some of the valuation metrics and whether Goldman is kind of historically over or undervalued here.
So, I mean, on the valuation side, when it comes to Goldman, I'm used to looking at price to tangible book value and comparing it to the ROTCE, kind of what they earn on it. And you can kind of do a regression over time, and depending on how much they earn as far as an ROTCE, it spits out what a tangible book value multiple should be. And if I'm sitting here today and they're trading at 1.5 times tangible, you put something like a 15% ROTCE in there, they're undervalued. I mean, there's definitely upside to come there. When I look forward and kind of my estimates, because ultimately earnings kind of drive it, I don't think I'm being aggressive. I mean, I'm ahead of the street and more optimistic than most, but I don't think I'm being aggressive. If anything, I think there might be upside as opposed to downside risk to kind of my earnings expectations out over the next couple of years, which theoretically could even drive more upside.
Shepard Smith here. Thanks for watching CNBC on YouTube.